Hi, if this video has helped you in any way, kindly, take a second to show your support to what we are doing for you. Be part of the growing Accounting Made Simple family. Click subscribe, like, share, and comment and hit that notification bell so you're always first to know when new content drops.
Hello students. My name is Samuel Muchai, your Accounting Made Simple tutor. And today I want us to study, to solve a question, a depreciation accounting ATD1 financial accounting. I want us to solve an ATD1 financial accounting November 2017 question 5B. Like I've said in the past, I've done quite a number of videos on depreciation accounting from the simplest level up to the highest level, that is the PPE movement schedule. Please see all our videos. I have a video that is called Courses and Methods of Depreciation Accounting. We have a video called 15 Reasons Why We Prepare, why we compute and apply depreciation expenses in the income statement and balance sheet. I have a video that talks about capital and revenue expenditure. We have a video that is called Property, Plant and Equipment Movement Schedule, and they are all trying to help you to master accounting for depreciation. And today I want us to talk about this question. It was tested in November 2017, question 5B. The question reads, Dora Johari started her transport business on 1st of July 2017. She purchased the following vehicles on the same day. KZ 414A pickup 4,500,000, KB 410C 4 lorry at 6 million, KD 300B lorry at 18 million shillings. In year 2016, 1st of January, she bought KL 330A pickup at 3.6 million. 30th June, bought KE 111B lorry at 12 million shillings. 13th September, bought KG 200A lorry at 18 million. In 2017, Dora Johari disposed KZ 414A for 3 million shillings cash on 1st of March. Also disposed KL 330A for 2.25 million cash on 1st of July. Trade-in KB 410C with KH 275D costing 7.5 million shillings. The dealer requested Dora Johari to pay an additional 3 million shillings. The trading transaction was completed on 30th June 2017. Dora Johari provides for depreciation at the rate of 20% per annum on cost on a pro rata basis. On a pro rata, we're saying depreciation is charged for every month used. And therefore, we are required to prepare the motor vehicle provision for depreciation for the 2 years, and we are supposed to prepare the motor vehicle disposal account for the 2 years. And therefore, the first thing we prepare always, anytime we have this kind of a question, the best thing is ensure that you have prepared the asset account, because the asset account will guide you a lot in terms of the disposal and provision. So if we say motor vehicles account, and we are told on 1st of July, she purchased the following vehicles. 1st of July 2016. One thing you need to know very well is that this business starts 1st of July 2016, and so its year is from 1st of July to 30th of June. The year is always 1st of July to 30th of June. So we are told on 1st of July, we bought Drew Bank. Always we say we buy Drew Bank, but we are buying a vehicle KZ 414A. KZ 414A, and we are buying it 4,500 shillings in thousands. And on the same day, KB 410C, same day, we bought the Root Bank, and we are buying KB 410C. KB 410C, and you are buying it for 6 million. You are buying it for 6 million. And on the same day, 1st of July 2017, 1st of July 2016, we bought the Ru Bank. We bought the Ru Bank. We bought the Ru Bank. KD 300B. KD 300B. KD 300B. And we bought it at 18 million. We bought it at 18 million. So those are the assets that we bought in at the beginning of 2015. At the beginning of 2015, and you know our year starts 2015 and ends on that 30th of June 2016. 2016, and our year always will be ending that 30th of June. So we are told on 1st of January, still the same year, this was our 1st of July, we bought 1st of July, but we are told 1st of January, in the middle of the year, on 1st of January 2016, we bought again through bank a pickup. We bought a pickup called KL3-A. KL3-A. We bought a pickup 3,600,000. 3,600,000. And on that 30th of June, at the end of the year, that 30th of June 2016, we bought KE, we bought Drew Bank, we bought KE 111B, 123B, 111B, costing 12,000, Now, our year ends on that 30th of June. Our year ends on that 30th of June. So, in 2016, we also bought a vehicle that on that 30th of September. But that 30th of September is the next financial year. It is not within this year. And every year, we open and close our accounts. Every year, we open and we close our accounts. So, we need to close this year's account. We need to close this year's account. And therefore, we add all the purchases. We are saying 4,500. This is 10,500. 10,500 plus 18 plus 3,600 plus 18, 1, 2, 3 plus 3,600 plus 12,000 plus 12, 1, 2, 3. We get, I repeat again, 4,500, 10,500, 10,500 plus 18,000, 18, 1, 2, 3 plus 3,600 plus 12,000. We get 44,100. 44,100. And therefore, that 30th of June, at the end of the year, that 30th of June 2016, we say balance carried down is 44,100. That 30th of June. At the end of the year, the balance we have is 44,100. That 44,100. We are supposed to prepare the motor vehicle provision account and the motor vehicle disposal account. Our disposals are taking place in 2017. So we are not disposing anything in 2016, the year 2016. So we are not disposing anything, we are just acquiring. So we're supposed to prepare the provision for depreciation and motor vehicle disposal account. So for this particular account, we need now to compute depreciation. For 2016. Depreciation for 2016. Now, depreciation, we are told for every month used, we were depreciating the assets for every month used. And the first 3 assets we bought the same day, and therefore we are charging the depreciation for the same period of time. And therefore, this 1st of July, so our year starts from 1st of July and ends of that is June. We were having them through the year, and therefore we are depreciating them for 12 months. So this is 10,500, this is 10,500 plus 18,000, we say 10,500 plus 18, 1, 2, 3, we get a figure of 28,500. So vehicles used through the year. The depreciation is 28,500. 28,500, and we are told that the depreciation rate is 20% per annum on pro rata basis, times 20%, but the period is 12 months out of 12. So we get a figure of times 0.2, we get a figure of 5,700. 5,700, but these others we bought on different dates. The next vehicle, KL, we bought on 1st of January. 1st of January, and from 1st of January to 30th of June, those are 6 months. And therefore, the one vehicle used for 6 months, it is 3,600,000 times 20%, but for only 6 out of 12 months. 3,600 times 0.2 times 6 divided by 12 months. You get a figure of 360. Then we have KE, which was purchased on 30th of June. Because it was purchased on 30th of June, we never used it in the course of it. Although we bought it in the year, we bought it on the last day. So we never used this vehicle. It was bought on 30th of June, so we never used it. So our depreciation is the total of this. Our depreciation is the total of that. So if we were to add them, 5,700 plus 360, we get a figure of 60. We get a figure of 60. And therefore, if we were to create a provision for depreciation account, so we say motor vehicles, provision for depreciation account, we are saying depreciation computation is an year-end adjustment, and therefore the record is always done at the end of the year. The record is always done at the end of the year. So we come here, and our end of the year is 30th of June. So you come here and you say 30th of June 2016. 30th of June 2016, we debit P&L, or we debit the income statement, we debit P&L account, and we credit provision for depreciation with 60. So our depreciation expense is...
Hi, if this video has helped you in any way, kindly take a second to show your support to what we are doing for you. Be part of the growing Accounting Made Simple family. Click subscribe, like, share, and comment, and hit that notification bell so you're always first to know when new content drops.
Our depreciation expense, we start accumulating our depreciation expense. And therefore, we are through with 2016. Maybe because of space, we could actually remove this, the computation for depreciation for 2016, remove it from there so that we can continue the motor vehicle account. And we are told on 30th of September, so the beginning of our accounting period is 1st of July 2016. 1st of July 2016, we say balance brought down, it is 44,100. Our balance brought down is 44,100, but we are told in 2016, on that 30th of September, is somewhere here. So on that 30th of September, which is in 2016-2017 year, 2016, we are buying through bank. We are buying another asset through bank, and the asset is called KG200A. KG200A, and it is worth 18,000. Now, in 2017, something very, very interesting is happening. We are told, like we have talked about disposal. We're told trade in KB410, this vehicle which we bought on 1st of July 2016, we are trading it in with another vehicle called 275D, KH275D. We are buying another one called KH 275D, and we are told it is costing 7,500. This vehicle is costing 7,500. The vehicle is costing 7,500. And then we are told the dealer requested DORA, but by the way, don't need to capture it as 7,500. The dealer requested DORA to pay an addition. So we are paying 3,000. We are paying 3,000. We are paying 3,000. We are paying 3,000 through bank. DORA is paying 3,000 through what? Through bank. And this is happening on 30th of June 2017. At the end of the year. 30th of June 2017. 30th of June 2017. Now, the trading transaction was completed on 30th of June 2017. So we need to look at, we need to deal with that account. We need to deal with that account, and that's what we are calling now motor vehicle disposal account. Motor vehicle disposal account. Motor vehicle disposal account. This is in 2017. This is in 2017. We are told that we are disposing KB410C. We are disposing this vehicle. And because we are disposing it, we will come here and we say on 30th of June 2017, we are disposing this vehicle. We are disposing KB410C. We are saying motor vehicle disposal account. We take it to motor vehicle disposal account. We take the original purchase cost to the motor vehicle disposal account. We take the original purchase cost, which was 6,000. We remove it from our assets. This vehicle has been depreciated for 2 years, but now we are removing it from our books of accounts. We are taking it to the market. I always tell people, you take both the accumulated depreciation and the value of the vehicle to the market. The motor vehicle disposal account need to be treated like we are taking it to the market. So we remove it, the original purchase cost, we credit the motor vehicle account to reduce the asset. A reduction in an asset, we credit the asset account. We credit the asset account. So to remove a motor vehicle from motor vehicle's account, we credit it with the original purchase cost. Original purchase cost. It is not the sales value. It is the value we purchased. Because we recorded the value we purchased when we bought it, we remove the value we purchased when we are selling it. So we come here and we bring 6,000. We bring 6,000 and we say it is coming from motor vehicle account. It is coming from motor vehicle account. Now we are told now this vehicle, we need to know the accumulated depreciation. We need to know the accumulated depreciation for this vehicle because we need to remove that depreciation from our books of accounts in 2017. What is the accumulated depreciation for this vehicle? This vehicle has been depreciated this way. In 2016, 2015, 2016, how did we arrive at the depreciation? We were saying it is 20% because we used it for the whole year. We bought it 1st of July, up to the end of the year we used it. So we are getting the depreciation for the whole year. So that year we depreciated it for 12 out of 12 months. 10% is 600, 2% is 1,200. 1,200. That was up to 30th of June. That was up to 30th of June. But we have used it. We have used it up to the end on 30th of June 2017. The next year here is 30th of June 2017. We have used the vehicle again, another one, sorry, here, up to 30th of June 2017. And therefore, total depreciation, accumulated depreciation, it is 1,200 times 2 years, which is 2,400. So we need to go to the motor vehicle disposal account and we subtract 2,400. So we, just like we have removed the whole amount of the original purchase cost of the vehicle from the vehicle's account to the motor vehicle disposal account, we need to also remove its depreciation from the accumulated depreciation account. So we come here and we say on 30th of June 2017, we are taking to motor vehicle disposal account. Motor vehicle disposal account. We are removing its depreciation from motor vehicle provision for depreciation, and we have said it is 2,400. We remove it from there and we take it to the motor vehicle disposal account. We bring it here and we are saying provision for depreciation. Provision for depreciation. And we are saying it is 2,400. Now, for this particular motor vehicle, we are saying the net book value as at the date of disposal, the net book value of this motor vehicle as at the date of disposal, we are saying 6,000 minus 2,400, it is 3,600. The net book value of our vehicle before disposal, it is 3,600. But we are told that the dealer, our new vehicle, we are told that our new vehicle, the vehicle we are acquiring is worth 7,500. Is worth 7,500, but Dohari is supposed to pay 3,000. Dohari, out of the 7,500, Dohari is supposed to pay only 3,000, meaning 4,500 is coming. It is like we are selling our vehicle. We are selling our what? It's like we are selling our vehicle, but instead of getting money, instead of debiting bank, we are debiting motor vehicle. Instead of debiting bank, we are debiting motor vehicle. We are debiting motor vehicle. Instead of receiving money, we are receiving a motor vehicle. Now, if this person should have actually given us money, and if he gave us money, we would debit bank, to record an increase in bank, and then we credit the disposal account to record a decrease in the asset. But now, instead of debiting bank, we are debiting motor vehicle. We are debiting motor vehicle. And we are told this motor vehicle is worth 7.5 millions, but out of the 7.5 million, we are only supposed to pay 3 million. We are only supposed to pay 3 million, meaning that the 4.5 million is being covered by our old vehicle. Is being covered by our old vehicle. So we come here and we say 30th of June, motor vehicle disposal account. Motor vehicle disposal account. The value of the old vehicle is 4,500. We are debiting the motor vehicle and we are crediting the disposal account with 4,500. 4,500, and we are saying it is coming from motor vehicle. It's coming from motor vehicle. It's coming from what? Motor vehicle account. 4,500 is coming from motor vehicle account. It is coming from motor vehicle account.
Hi, if this video has helped you in any way, kindly take a second to show your support to what we are doing for you. Be part of the growing Accounting Made Simple family. Click subscribe, like, share, and comment, and hit that notification bell so you're always first to know when new content drops.
So it's coming from the motor vehicle account. So if you just look at that question by itself, at least that transaction by itself, we can find out, you can actually see something that the vehicle is, the debit is 6 million, but here it is 6,900,000. 6,900,000. And basically, we are saying we are selling it at a gain on disposal. We are selling it at a gain of disposal. Essentially, we are saying if you say 6,000 minus provision for depreciation of 2.4 million, we said we are being left. The value of the vehicle is 3.6 million. The value of the vehicle is the net book value. The net book value of the vehicle is 6 million minus 2.4. You get 3.6 million. But instead of the person giving us 3.6 worth of the new vehicle, he's giving us 4.5, meaning we have a gain on disposal. For this particular vehicle, we have a gain on disposal. For this particular vehicle, we have a gain on disposal. So then we are told on 1st of March, we disposed on 1st of March, on 1st of March 2017, we disposed KZ 414A. KZ 414A. And we are saying KZ 414A, we are taking it to motor vehicle disposal account. We are taking it to motor vehicle disposal account. Now, KZ 414A, please remember always, even when you are given the value of the money you are getting when you are disposing, we do the amount we take from the asset account is the original purchase cost. Some students, this question tells you disposed KZ 414A for 3 million shillings cash. That's the money we are receiving, but that's not the money we bought it at. So you find out how much money did we buy it at, because it is the money we had put in the account by debiting the account that we are removing from the account because we are selling it. It is the money we had put into this account. It is not the money we are getting when we are selling. It is the money we had given out. It is the money we bought the vehicle at that we are removing from the motor vehicles so that we take it to the market. We take it to the market. So you look for KZ 414A and you look at it, you can see is this one, KZ 414A. Yes, KZ 414A. It is being disposed on 1st of March. On 1st of March. And therefore, we look at the amount. KZ 414A is 4,500. We had bought it at 4,000. Although we are receiving 3 million, we had bought it at 4.5. We had bought it at 4.5. So it is the 4.5 we are removing from the books. It is not the 3 million. It is the 3 million we got to the disposal account. But the figure we are removing is the original purchase cost. So we move it from the motor vehicles account by crediting it, and then we debit the motor vehicle disposal account 4,500. And you are saying it is coming from the motor vehicle account. Motor vehicles account. Now, remember, every time we are removing, we must remove the original purchase cost and also remove the accumulated depreciation. We also remove the accumulated depreciation. So what is the accumulated depreciation of this vehicle? What is the accumulated depreciation of this vehicle? Now, this vehicle we bought the 1st of June 2016. So 1st of July 2016 to 30th of June 2016, the depreciation was 20% of 4,500, and that is times 12 months out of 12. And that is 450 times 2, 900. But from 1st of July 2016 up to, we are disposing it 1st of March 2017. 1st of March 2017. Now, these are the first 6 months in 2016. These are 6 months. And then 1st of March, meaning January and February. January and February. We have not used it in the month of March. We have only used it in 2017. We have only used it for 2 months, January and February, plus the 6 months from 1st of July 2016. So these are 7 months. 6 months, 6 months plus 2, 7, 8 months. So we come and we say 20% times 4,500 times 6, 7, 8. 8 divided by 12, we get the total accumulated depreciation. 0.2 of 4,500 times 8 divided by 12. Yes. 600. We get 600. We get 600. 0.2 times 4,500 times 8 divided by 12, we get 600. And therefore, the total depreciation from the date of purchase to the date of disposal is 1,500. Plus 900, we get 1,500. So we remove that depreciation, just like the way we are removing the asset from the asset account to the disposal account, we are also removing the depreciation from the depreciation, motor vehicle depreciation account. But for the first year, we must close it down. We must close it down. We must close it down. 13th of June 2017. Motor vehicle. Did we dispose a vehicle in 2017? 30th of June 2017. 2,400. This is being removed in 2017. This is being removed in 2017. 30th of June 2017. Motor vehicle disposal account. 2,400. In this year up to 30th of June 2016, we never disposed any vehicle. We never disposed any vehicle, and therefore the charge for the year, the accumulated depreciation charge for the year is carried down. The accumulated depreciation charge for the year, 60 is carried down. 30th of June 2016, we say balance carried down is 60. 1st of July, balance brought down. 1st of July 2016, balance brought down is 60. And it is here that we are now disposing. We disposed the first vehicle, now we are disposing the second vehicle. We are disposing the second vehicle, and we are told that we have clearly identified that its accumulated depreciation is 1.5. Its accumulated depreciation is 1.5, so we remove it from our provision account. We remove it from our provision account. I remove it from provision account because provision account has credit balance. We always debit. We always debit. We come here and we say, and it was being done on 1st of March 2017. We are saying motor vehicle disposal account. Motor vehicle disposal account. So we reduce the provision as by debiting it as we credit the disposal with 1,500. We credit the disposal with 1,500, and we are saying it is motor vehicle provision account. It is coming from provision what? Provision account. Now we are saying we bought the vehicle. We say we bought the vehicle as 4.5. We have lost the value to the tune of 1.5. Meaning the net book value of this vehicle is 3,000. The net book value is 3,000, but we are receiving money, we are selling it through bank. We are selling it through bank, 3,000. So what are we doing? We are debiting bank and we are crediting disposal account with 3,000. We are creating disposal account with 3,000. Now, this vehicle, the net book value is 4.5 minus 1.5, you get 3,000, but you are also receiving 3,000, so we have not made profit, we have not made a gain or loss on disposal. Then we are told there's a vehicle KL3.A. KL3.A. Again, this vehicle was bought on 1st of January 2016. It was bought on 1st of January 2016. And therefore, the first year, the vehicle is KL3.A. KL3.A. Now, first year was only for 6 months. The first year was for 6 months. KL3.A. KL3.A. We bought the 3.6 million. We bought the 3,600,000, and the depreciation is 20%. But we only used it because we bought on the first day of the half of the year. We used it for 6 months. We used it for 6 months. So let's get the depreciation for the first year. The first year depreciation was 3,600 times 0.2 times 6 divided by 12. The first 6 months you get 360. We get 360. We get 360. Yes, that's true. We get 360. Then up to that year of June 2016, then we are told we are selling the vehicle on 1st of July 2017. We are selling it on 1st of July 2017, and therefore we are selling it at the end of the period. We are selling it at the end of the period. Now, so it is it will be, we will have usage for 1 year. We have usage from 1st of July 2016 all the way to 1st of July 2017, meaning we are using it for a solid year. And therefore, second year, we are use 3,600 times 20%, but we are using it for 12 out of 12 months. We are using it for 12 out of 12 months, and 3,600. It's this 720 times 0.2. It is 720. So that's the value it has lost up to the date of disposal plus 360. That's the value it has lost up to the date of disposal. It has lost value to the tune of 1080. It has lost value to the.
Hi, if this video has helped you in any way, kindly take a second to show your support to what we are doing for you. Be part of the growing Accounting Made Simple family. Click subscribe, like, share, and comment, and hit that notification bell so you're always first to know when new content drops.
Yes, 1080. So we again carry the depreciation from the provision account. We take it away to the disposal account. We come here and we say 30th of June 2017. So we say motor vehicle disposal account. Disposal account, we take 1080. We take 1080. We take 1080 and we come to this disposal account. And you know what we are disposing? We are disposing KL330A. Motor vehicle account. Motor vehicle account. We are receiving 1080. What are we doing? We are removing the depreciation from the accumulated depreciation account. We reduce the depreciation by debiting the depreciation, and we bring it to the disposal account by crediting the disposal account. Now, this vehicle again, we get the original purchase cost. We get the original purchase cost of our vehicle. We get the original purchase cost of our vehicle, KL330A, and we know it is. We say it is 3,600, and we remove it from our vehicles. We remove it from our vehicles, and we are removing it on 1st of July. On 1st of July, and we are saying motor vehicle disposal account. We are removing KL330A. KL330A. We are removing KL330A, which has a value of 3,600. So we credit the asset account to remove it from the assets, and we debit the disposal account with 3,600. With 3,600, and we are saying it is coming from the motor vehicle account. It's coming from motor vehicle account, KL330A. KL330A. Now this vehicle had been bought at 3.6 million. And it is being, the depreciation is 1080. 1080. So if we deduct the two, 3,600,000 minus 1080, we get a net book value of 2520. That is the net book value. But we are told we are receiving cash 2.25, 2,250,000. We are receiving 2,250,000. Meaning we are debiting bank 2,250,000 to record an increase in money in the bank. We debit the asset of bank as we credit the disposal account. We come here and we say bank. We come here and we say bank. And if you if you subtract 2520, the net book value, 2520, the net book value, you realize we are selling it at a loss. We are selling it at a loss. We are selling it at a loss. So for the disposal account, that's the way it's supposed to be. For the disposal account, that's the way it's supposed to be. We close it that way. Let's add it up completely. 2450. Provision 2450. Was it 24 or 2450? 2400. 24, looks like 2400. Yes, 2400. So 2400 plus 4500 plus, this is 4500 again, 4500 plus 1080 plus 2250. The credits are 14,730. Let's get the debits. This is 10,500 plus 3,600, it is 14. So this side is the debits are more, 14,100, and the credits are less. So the credits are less minus, no, the credits are more, 14,730. The credits are more, 14,730 minus 14,100, 14,100, we get, so 14,730 minus 14,100, we get a figure of 630. Get a figure of 630. We say we take it where? We take it to P&L account. We take it to P&L account, 4730. So we are selling, overall we have a gain on disposal. Overall we have a gain on disposal because we are debiting the provision for, we are debiting the motor vehicle disposal account and we are crediting P&L. We are crediting P&L. A credit to the income statement always is an income. A credit to the income statement is always an income. So as we debit the disposal account, we are crediting the income statement to record a gain on disposal of motor vehicles. We are recording a gain on disposal of motor vehicles. Now, as that happens, we need to compute the depreciation. This is what we were supposed to have done for the disposal account. That's what we're supposed to have done for the disposal account. Let's try to find out. The depreciation charge for the year. Let's get the depreciation charge for the year. Let's get the depreciation charge for the year. Something very unique here. Now we need to see. And this is something. If you understand the concept, you just enjoy doing depreciation accounting. Now we always say, in every situation like this one is even simpler. This one is even simpler. It has the complication I want to talk about. If you look at this question, if you add them up, we need to get the 30th of June 2017 balance carried down. So our total debits. So we are basically, you need to understand the asset account to be able to compute depreciation for the asset account. So we are saying at the beginning of the year we had 14,100 worth of motor vehicles, but out of the motor vehicles we had at the beginning, we disposed this and this and these motor vehicles. So we had 14,100, but that's what we had at the beginning of the period, but it is not all of them that we used through the year. We never used this through the year, we never used this through the year, we never used this through the year. So we can actually get the depreciation charge for the year by saying assets, depreciation for assets used through the year. Depreciation for assets used through the year. How do you get it? You're saying at the beginning of the year we had 44,100, but there are some which we sold in the course of the year. By the way, this one we also never, although we sold it at the end of the year, we sold it at the tail end of the year. But this vehicle, this one, we sold it in March. We sold it in March, this one in July. So this and this, we are selling them at the end of the year. This and this, you're selling them at the end of the year. But this one, we sold it in March, meaning we never used it for 12 months. So 44,100 minus the one we sold in the course of the year. We never used this one for through the year. Minus 4,500. We get 39,600. 39,600, 4,500. Yes, times 20% times 12 months over 12 months. So times 0.2 times, you get a figure of 7920. 7920. I want to repeat again. you study the movements of your assets. You always ask yourself, which are the assets that we had at the beginning of the year and we were with them up to the end of the year. Dates are very important in accounting. We had this, everything that we had at the beginning of the year was worth 44,100. But some of it we sold on 30th of June, so at the end of the year. Another one is sold in March, but the other one is sold in still at the end of the year. So the one we sold in March, we never used it through the year. And we are charging depreciation for every period used. So you get the original amount of money, you subtract the one which we sold in the course of the period, everything else including this and this you charge depreciation. Then we compute the depreciation for the one we sold. Depreciation for vehicles sold in the year before year end. Before year end, and we are saying we sold on the 1st of March 4,500. We sold on the 1st of March, meaning for 4 months we never used this vehicle. But this vehicle, we had used it from 1st of July all the way to December, 6 months, and then January and February. We used it for 8 months. Six in the previous year and 2 in the current year, January and February. So 4,000 times 20% times 6, 7, 8. 8 out of 12. 8 out of 12. 4,500 times 0.2 times 8 divided by 12. We get a figure of 600. And therefore, the assets we had at the beginning of the year,
Hi, if this video has helped you in any way, kindly take a second to show your support to what we are doing for you. Be part of the growing Accounting Made Simple family. Click subscribe, like, share, and comment and hit that notification bell so you're always first to know when new content drops.